G'day and welcome to our webinar, the video we've put together that covers off a night I had out with property spruikers that came to my small town of Horsham that I decided to go along to and understand what they're doing, how they're trying to sell their properties, and just get an idea of the triggers they're pulling to try to get people to buy. Now, for those that have watched my videos in the past, you'll know that I'm not very positive on property ownership, particularly the type of properties that these people are trying to sell, where it's more than likely apartments and units in high rises or high density housing. They obviously clearly may well be involved with the developers and all the way along the food chain, so a lot of money in it for them to sell these properties. But so I went along to understand how they do it. I last went to one of these again in Horsham when I first started in the financial planning industry. Went along to one to see, so I wanted to see if the rules had changed. In brief, the rules haven't changed. But so we'll go through. I've put this presentation together. It's been a few months since I was there, but as life gets in the way and work gets in the way, been very busy. So what I'll do is we'll just go through bit by bit all the the emotional side of things, the way they can send people down a certain path to get the outcome that they're after. Now, some of this will be reasonably negative. I accept that, but I'm very cynical when it comes to investing. People are trying to get money out of people all the time, so you become very cynical in my game because there's so many things, ways that people get caught. But I've also got a slide in here that shows the alternate path that the positive side that I'd recommend people go down in terms of investing, and that's investing into businesses. But I'll touch on that in a second. So there's more education rather than just a flat out negative. And right at the end, I've got probably 5 or 6 real life first person examples of property ownership. One of them is actually mine, so we'll start chipping through it. And as you can see, I've titled this My Evening with Property Spruikers. I'll never get back that 2 hours, and obviously it's there, the pathway to get you to buy property off them. So I think it's worthwhile that I make an acknowledgement that in the past, the last 15, 20 years, we've seen an amazing property boom. We've seen interest rates come down to record lows, and they'll probably get lower again. And people have made very good money, amazing money over the long term. But if we draw a line in the sand, that's the past. We've got to worry about the future. And also over those same time frames, many people haven't made anything at all. Some people have lost money, and we'll cover that off in some of the some of my examples, the real life examples at the end. So I acknowledge that people have made money. I've also acknowledged that people have lost money. There are markets within markets. Property spruikers will generally be selling developments, multiple apartments, very more of a high risk apartment area to invest, particularly given some of the issues we've seen, particularly in Sydney, that the quality of these, not just the internal fittings, but the bloody foundations of these properties have been, have had issues. So that is a real concern, and I feel very sorry for the people that are involved and have their money in that space. I also want to comment that I have been a property investor in the past, but I learnt those lessons 25 years ago, and so it's not just a blind negative view that doesn't suit what I do. If there was good money to be made in property, I'd be there. If it was the best asset class to make money out of, I would be there. But based on my experience and what I know and what I've done, it's not. But this is about informing people, providing knowledge and education so you can make a decent decision, particularly around this area. I've always got to put in my disclaimer to say that this is general advice only. I'm not taking into account anyone's personal objectives, financial situation or needs. So if you need advice, I'd recommend that you speak to a suitably qualified financial planner or an authorised accountant, someone you trust, and I'll cover that off in this presentation around what the property spruikers do to make sure that you don't go and have a chat to someone that's a bit impartial. So let's kick it off. So what's the process to be sold a property by a property spruiker? Well, first I get you to a seminar. They get you to come along in the flesh. To do that, they offer obviously free tickets. And what happened in this scenario is Rachel, one of our financial advisors here, received a phone call. She had won free tickets to go to a webinar at absolutely no cost. This was a cold call, and said it was based on a competition that she entered, either going to Safeway, Coles or Facebook, which most people would do over a week. Possibly a blatant lie, and if you go there you get a free tablet. So free seminar, you've won something, come along and you'll get something for free. They use a whole heap of emotional tactics. The psychological side of it was quite interesting, the path they took down. So it leads them down a path to get them to buy, to buy a property off them. So they're essentially scaring you, then inspiring you. So no age pension, volatility of markets, and then here's the path. So these are pretty sharp presenters, and very convincing in what they're doing. So the scare tactics are that there's only a very small percentage that retire independently, and that is relatively true. There's that is probably the case, but they talking about that most people fail financially. They talk about longevity in retirement, the same as what I do. That people that gets to 65, I often say you're a 30-year investor. When you've got a husband and wife in the room, one of you will get to mid-90s more than likely. And they were talking about the standard of living drops within retirement. Now, as we all approach retirement, the idea of dropping our level of living standards, would not excite any of us. And also, they show the bar graphs, very low per week incomes, majority at about $300 per week. I can't quite remember what they were meaning by that, but just about people doing it tough in retirement. And what they didn't mention was Australia's safety net. Luckily, we live in Australia. We have the age pension. That for people under certain income levels and certain asset levels can get the age pension. So plenty of people can retire on 100,000, 200, 300, 400,000 and be very comfortable, use some of their money, some of the age pension, and have a very comfortable life. So a little bit of scare tactics, but they forgot to mention that, and I think that was a huge omission, but again, that's part of the scare tactics. Then they were selling the bucket list, and the bucket list was very much around trips that the presenter wanted to go on his own retirement. He talked about driving hiring a Ferrari in Italy. He spoke about he wants to buy a $40 coffee in France. Now, if you really want to spend $40 on a coffee, I think you've got some issues, some ego issues you need to deal with. I'm happy with the $3, $4 coffee that we pay for here. It doesn't have to be $40. So that's the bucket list dream. So really triggering a lot of emotions, and he was always throughout the whole process looking for feedback from the audience. About 40 people in the room, and at the start it was it was all very silent, and not many people were doing anything. But as the presentation moved on, people got more animated and actually excited. So he got them emotionally involved. So as I said, very good presenter. Now, to achieve an independent retirement, again, they're sort of saying, right, you need big money. So you need a lot of money to retire early, and it's got to be a life-changing amount of money. So we're not talking about $5,000, $10,000, $20,000. We're talking big money that can change your life. And they've got the strategies to provide these results, strategies to build wealth. And again, all the tactics, these are the stuff that I've written down for the whole seminar. Build wealth, real wealth, life-changing wealth. And by the way, you can get some substantial tax savings because everyone likes to save tax. So this is part of the carrot side of things. And then sort of go on, what do most people, most do, and what do most successful people do? Well, what most people do is work incredibly hard and spend and don't save. What do most successful people do is work hard and they save money. He had a copy of the Rich Dad, Poor Dad book, and about savings savings invested into passive assets. So this is all correct. This is all good stuff. Without saving at the start, people don't get to invest, and therefore can't push towards a good, comfortable retirement. So this is all quite right. You do need to save before you can talk about where you invest. So then they go on to say, well, there's two mistakes that happen. One is people don't plan and then they don't start. Again, I agree with all this, but the don't start point was really all about trying to push people into action, to make a start, not next week, not next year, not after New Year's Eve, but let's start and we'll be at your house over the next few days for 2 to 3 hours and we'll make a start. That's how quickly they wanted people to start. So how do the rich invest? Well, they spoke about schemes and fads. They spoke about Bitcoin or emus, all the different schemes and fads that are out there. Couldn't agree more. All very useful. And then he said, well, what you do need to do, you need to invest into cash, shares, and property. So this is where it became very pointed. So he'd give you the three options. There's cash, there's property, which is shelter, and then there's the share market. And then he said, well, but where do we invest into those areas? So again, he wasn't negative about the share market, which I was surprised about. I thought that could have happened. And he essentially said that the residential property market and the share market returned about the same time. And over a similar time frame, last 19 years, they've both returned around 11% plus, which I'm sure we could go and find some information that validates those figures. So then you go on to say that both these asset classes, either the share market or the property, will double every 7 to 10 years. Now, that's questionable, obviously depending which asset class you're talking about. And so every 7 to 10 years, and so for all his figures thereafter, it was double every 7 years. And obviously he wasn't negative about the share market, and it even suggested that you should have some of these other assets. But the foundation, as he built the triangle for people to think about in their head, that the foundation should be property. And then you have some cash and some shares, but the foundation, the bulk of it, needs to be property. So again, this is all pushing people down the path that they want them to take. So a spruiker's reason to buy property over everything else. Well, it's because of the huge amount of expenses and cost to own the property. So it's all the ongoing cost that provide you the tax deductions and therefore tax savings. And then the government will give you your tax back. All this makes sense and is very attractive. Whereas if you own a share in a business, say CSL, or you own Microsoft or Google, you don't have any expenses because the company takes care of the cost of running the company within the business itself. So somehow, and you'll see down the bottom here in a lovely little not so smiley face, that they've turned what I see as an out and out negative, that you own an asset that is costing you a lot of money because you've got to pay rates, you've got to pay maintenance, you've got to pay all these extra things, body corporate fees, insurances, you've got all this stuff happening. They turn that negative of cost, expense, where you're writing checks, they turn that what they called a positive, is a vast negative. And we'll touch on that in just a moment. So again, they also, more reasons to buy properties, that 95% of people will rent in their lifetime. Is it true? Is it not? Does it matter? No, it doesn't. They state that 30% of homes are rentals. I'm sure we could find some information on Google that supports that. And you get both capital growth and income. Sometimes yes, sometimes no. And then you get all the tax advantages, which leads me on to the question of, should you buy a new property or should you buy an old property? Now, of course, the answer is you need to buy a new property. Now, why is this? Well, it's a tax thing. If you buy new, you can claim depreciation of around 2.5% on the property. And you can even claim a higher amount on the fixtures and fittings. If you buy an older property, you're not going to get the depreciation at these levels. I'd recommend you chat to your local accountant regarding some of those issues. I'm not a tax accountant, but this is my understanding of the system. Excuse me, I'll have a drink. Again, it's crafted in a way to direct you down a path that gets you to do exactly what you want to do, and that is for you to buy a new residential property off them. So if we have a look at some figures, so here's where I'm really saying, well, are tax deductions really a good thing? So for example, if you've got a $500,000 loan, and these are the figures that they were talking about, this is high risk. Going to the bank to borrow $500,000 is, there's risk accompanied with that into one asset class. So the cost of ownership, we've got nearly 45 grand. You've got rent of 18 and leaves, and this was actually their figures, leaves 26.5 grand in deductions, including 14 grand in depreciation. So that's sort of non-cash. That's the depreciation of the building, the 2.5%, and then the fixtures and the fittings depreciate over time. And that depreciation is just acknowledgement that each year the property devalues, and at some stage in the future the fixtures and fittings will need to be replaced. So that's a future liability building up. So if we exclude the non-cash deductions, it means that you've lost $12,500 in cash each year. Now, what they will do, they will talk about these tax variations where they'll write to the tax office, they'll do this for you, and it means that you can afford to lose this money and that you only need $100 per week because of the tax savings that you get through this really substantial tax deduction up here. Means that you only need to contribute $100 a week. So it makes it seem affordable. But it doesn't seem affordable to be losing so much money each year. And that loss is substantial. That's 12 grand per year in cash flow. That's you're losing money. It is a huge issue. Essentially, you are negatively geared. Negative gearing means that you are losing money. Positively geared means that you've got money coming in. Talk to your tax accountant about some of these issues. Tax variations alike, it starts to get complex. People start to glaze over. But at the end of the day, taking the depreciation out of the equation, you are losing money. That's what it gets down to. You'll need to find money to fund these properties. Now, once they sell a property, what happens after the sale happens? If it's $100 per week, you've got to commit, turns into $200 or $250. Not their problem. There's no going back. So how can you afford it? Well, tenants pay the rent, you vary the tax, and a bit of your own savings. Everyone can afford $100 per week. So they go at great lengths to say, well, $100, you've just got to save a bit here and a bit there, and everyone can do it. And we've got to remember, we can't forget OPM, and they use the words OPM a number of times, and that is other people's money. It's a cliche that's been used for the last 20 years that I've been really watching the market. So essentially you're saying go to the bank. You're using the bank's money, and don't be afraid to gear up, whether it's $500,000 or $600,000. So again, these are their words, these are not mine. A small amount of your money plus gearing, which is debt, equals a large and growing asset. Well, we hope it's growing. So the key points here is you can personally, as a financial advisor and have been investing for a long time, you never make a decision around investment by putting tax before the quality of the investment. You have to assess the quality of the asset you're investing into. Do not put tax first. Longer term asset values are driven by an increasing income and profitability. And this is where I've got an issue with the place that we lease here. Our lease contractually is set to go up with inflation, and inflation's running at 1.6%. There's no way ever I'm going to commit my money to an asset where the income, the lease, the profitability only goes up with the cost of living. That's going sideways. The environment has changed. Obviously, there's no easy and cheap loans from the bank anymore. We've had a Royal Commission. So the money is cheap, it's just not easy anymore. So the banks aren't lending it out. Supply and demand are drivers of valuations. There's going to be prestige spots. There's going to be spots over rivers, over the beaches that are always going to be in demand. So, as I said at the start, there's markets within markets. But the stuff that they're selling, which will generally be high density stuff, apartments, which can be put up at minimal cost because there's not much land value there, that's generally what they're going to try to sell you. So again, some of the key points here: it's a huge amount of debt equals a huge amount of risk. It all goes into one asset class, so you've got no diversification. And one asset class is generally one property. The fact that property doubles every 7 to 10 years is a blatant lie. It is not correct. There's no stats to prove that. These people are not tax accountants. They are not financial advisors. And they don't have to put their client's best interest ahead of their own like we do legally as financial advisors. And if it all goes wrong, they won't be there to help you. They've sold the property, they've moved on to the next small town to sell the next property to the next person, to sell the next dream. How they can do this without being authorised and properly licensed to give advice, well, property doesn't fall under financial product legislation. That's the loophole. I disagree with it completely. I wish the Royal Commission handled some of this stuff because some of the flow and effect from this poor advice, which lines their pockets, not the investors, should have been covered, because I think it has a detrimental impact on people's livelihoods and financial well-being. So what's wrong with the strategy? Well, the environment's changed. The Royal Commission's come along. Money is hard to get. The demand has reduced. Losing money each year can only ever work if the value of the asset goes up each and every year, and no asset will constantly always just go up. There's volatility, and like the share market, there'll be years where it goes down. It'll be negative. Over the longer term, it will do extremely well in that space. But property, unless there's an increase of profitability and lease income substantially, what's pushing the valuation? They also spoke about to help fund a property portfolio. So they're not just talking about one; they're talking about 2, 3, and 4. That you can drag out the equity in your own home, and that can help you gear up. So obviously, look for some cash flow, but also they'll be looking for equity that can help for possibly multiple purchases. So using from your own home will then put your own home at risk. They did mention utilising your superannuation to expose your retirement benefits. The ATO has got huge issues with super funds being set up by property one-stop shops, and all of a sudden you have your retirement asset with one asset class in it, and that's one property with a heap of debt. Huge issues. One asset class, high fees, compared to a simple diversified fund like an industry fund. So, Going to the next one, it's all in-house. Everything is done in-house. They have their own conveyancers, the lawyers, brokers, financial advisors, accountants. The reason why they do that, in my cynical opinion, is that it stops you from speaking to your own professionals, where you might get an independent and unbiased opinion. So what I recommend that you do, if you go to one of these property spruikers, get independent professional advice before making any investment decision. Do not sign on the dotted line when they come to your house, because that's what they'll try to do. Pump up the enthusiasm at the webinar, come to your place within the next 3 days, and they did state spend 2 to 3 hours with you. Sounds riveting. And they'll try to get you to sign up on the spot. Of course, they're going to be involved at so many different levels. They may have ownership in these properties. They may be pure salespeople that are contracted to sell these properties and they may receive 20, 30, 40,000 worth of commission. I don't know. From my own experience as a financial advisor, we've been regularly approached to sell apartments in major capital cities, and the promise of 20 grand in commissions to sell a property. Of course, that will never happen under my watch, under my business. So then they talk about, obviously you buy, build up equity because it doubles every second year, and then you buy another one until you've got 4 or 5 or 6, and when you get to retirement you sell the worst 2 properties, pay off all of your debt and have the rental income for the rest of your life. And also that all looked pretty awesome given that it doubled every 7 years, but the pure fact is that it doesn't double every 2 years, and the type of properties that these guys are selling are highly unlikely to double every 7 years. So I think some of the questions that need to be asked, say, righto guys, if the property is so good, then why? Then why are you trying to sell it to me? If it's that good, why don't you keep it for yourself? And if property is so good and doubles every 7 years, why do the banks, lend you the money to go and buy it or lend against it? Why wouldn't they go out and buy it themselves for their shareholders? Why did Westfield has now merged with a big French business. Why did Westfield, they've never really owned the Westfield shopping centres. They put those assets into unit trusts, which they sold off to the general public, but they retained the right to manage and take care of the lease agreements of those properties. So Mirvac, Stockland, they sell their property and manage it. They don't keep it. So if it's so good, and these are the questions I'd recommend if you get yourself in position with property spruikers trying to sell you an apartment that you probably don't need with a lot of debt, why the hell aren't you doing this yourself? Now, what I'd recommend is that you go and check out Peter Thornhill, do a search for Motivated Money, buy his book. He's been very generous with his information over the time. And on our website, there is a course which is essentially Peter's information, which he's given us permission to use. So thank you very much, Peter. So this is why a very generous shout out to Peter. But that is a free course on our website. I make no money out of it whatsoever. But this is essentially the gold standard in understanding the right asset class to be in. So Peter compares cash, property to the share market, which is businesses. So don't be scared about the share market. The share market is essentially an auction room for businesses. So go onto the website, check that out. Check out his book if you're a keen reader. If not, go through the videos, which is part of the course that we've got on our website. And just a bit of a look. This is some of Peter Thornhill's work again, and this goes back to 79 through to 15, $100,000 invested within the all industrials. So that's the Australian share market excluding all the resources, the all industrials, compared to the listed property trust. There is no decent data regarding residential property, so we've really got to use the listed property trust. Again, this is Peter Thornhill's work through Motivated Money, but if you look at the value all those years later, it's probably around $300,000, and you're probably receiving income of 10 grand a year on a $100,000 investment. If that same amount of money was invested into the share market and the all industrials, it's probably worth 1.8 mil and bringing in 80 grand per year. And this is just a further breakdown of some of Peter's work, where he says this is why he invests in the all industrials and this is why he doesn't invest into the resources. Now that has recovered quite substantially. It's probably around 2.8, the resources. They've had a strong rebound over the last couple of years, but this is also at around 12 mil as well. The green line in between is the All Ords, which is the average between the two. So if you want to know where I spend my time for myself and my clients, it is in this space here, the All Industrials. And that can be, international businesses like Google, like Microsoft, like Apple, very high quality businesses. These are some of our examples. Apartments in remote WA, about a $400,000 cost to buy, plus the cost, stamp duty and the like. Within 5 years, these clients were told they're expected to sell at a 50 grand loss per property. So 5 years, they did not double. So this is a client. These are first-hand, first-person experiences. These are not third-hand. So 7 years ago, St Kilda Road, a studio apartment, 330, will be lucky to get their money back. So they're hoping to break even on that one. Again, Melbourne apartment again. This one was purchased 10 years ago. 330 again, told it'll be worth $1 million in 10 years' time. Again, hoping to get their money back. This is more recent, so 2018, I think March when it settled. Sold for $440. The Commonwealth Bank went in, did a valuation at $370,000. Disaster day one. These are overpriced properties because there's so many snouts in the trough, so many referral fees to be paid to the financial advisor that recommended this, which, as I said, is a disaster. But this is exactly what has happened. We don't know the outcome of this one. Again, this is a Horsham one. 2013, 187 plus cost plus stamp duty. Sold 5 years later for 207 and a bit less cost, so it would have cost 10 grand to sell. Gets you back to pretty well even Stevens. Airlie Beach, in 5 to 6 years, these people are down 100 grand over that time. Now, there'll be reasons why it might be supply and demand. It may not be one of these properties. They're just a picture of Airlie Beach. I don't know. But these are real life experiences that my clients and the people I talk to are having. This is actually my place. So just the background on this, back in 2002, 2003, we had the GST was introduced to Australia. And what people were doing is they were rushing prior to 2000 to do all the building, to do everything, so they didn't have to pay an extra 10%. So the government was worried about that, so they implemented the First Home Buyers Grant. And that was really fuel to the fire, and people were just rushing to the property market. And what they were doing was essentially buying them sight unseen. Early days on the internet. We put this property on the market. This was our home for 8 years. We sold it as an investment property. So we said, this is our investment property. We want $189,000 for it, and we want to lease it back securely for the next 3 years. This is the lease we're prepared to pay, and we sold it within a week, sight unseen by the client, for within 2 grand of what we asked. And they came up and have a look at the property afterwards, and it was after the cooling off period, which was odd. So my assumption is that, or I do know that it was fully geared, 100% lend. So the total cost would have been, say, $195. My mate, it was the real estate agent. He sold it. We went back and had a look at the property. Zero work had been done on it. You walked into the kitchen, and my mate Rob said, geez, well, if you dropped your marbles, you know where they would go. They'd all go down to that corner, given the movement in the place. And there was a monster burn hole in the middle of the lounge room that wasn't fixed. Apparently vacuums do catch fire, and cigarettes and other smoking implements don't get dropped. So no, huge disrepair. They had 220 on it. It got sold for 210. I know that commission was taken out of 10 grand and 2 grand worth of costs. So that's an 11-year example, and an 11-year disaster. They would have been negatively geared, which meant they lost money on it each year. That may have made them feel good about you reducing a little bit of tax, but tax deductions is only going to save you what your tax rate is. So it's like spending $1 to save 30 cents. Doesn't make any sense. So they are real life examples, both in capital cities and in small regional areas. I would encourage everyone to go and check out some of these government sites. So you can see here that, consumerlaw.gov.au, spruikers, there's pages on this stuff. Money Smart, again, that is the ASIC's education portal to hopefully provide education and knowledge to investors to understand finance. There is lots of information out there, not just what I'm doing, but this is, you don't want to get caught, by these people, because they will sign you up within days and the risk is huge. So I hope that's helpful. A little bit negative, go and check out Peter Thornhill's stuff on that video. I'd really recommend you do that. Educate yourself, understand what is the right asset class to be in, understand where you're going to get the best performance over the rest of your investing lifetime. Really important stuff. Thanks for listening, and we'll catch you soon. Bye.